right, hi everybody, Clayton Smith here, and I'm here with Brayden Sutton. We're at the Vancouver Resource Investment Conference, and met Brayden here this morning, and we were having a little bit of breakfast. We had some interesting people at our table.
We certainly did.
Rick Rule was at the table having breakfast with us.
He was indeed, the man himself.
The man himself.
Pretty cool to have him join us.
That was pretty good.
Very interesting breakfast, very informative.
And yourself, I remember during the breakfast you had mentioned that you wrote a book.
I did.
Can you tell me about your book?
Certainly, yeah. I've been a speculator in the markets this is my 20th year. I really put it together and finished the book during the COVID era, because if you recall, there was the GameStop phenomenon, and essentially all of the 19-year-olds sort of came out of the woodwork, started trading on their iPhones and thinking that they're professional speculators, which is just not the reality. And I know that those things don't end well. I was quite hurt in 2008. I was leveraged. I was one of those stories with an investment that went negative on me. Started over in 2009. Had quite a bit of success in natural resources and energy. And during that period, I had made some money, I had lost a lot of money, and I really wanted to reflect on what decisions I made mentally. In other words, when fear and greed being the main drivers in the market, ultimately that's what moves markets up and down. Now, if you can detach from those two emotions and make business decisions, that's where investing starts to get exciting. And what most people are doing, my opinion, is really blind speculating. It's really gambling, ultimately. And what gambling is really
chips
chasing.
On the table.
Yeah, it's chasing. You heard something, you maybe are afraid of missing out. The word FOMO became a term in the last 5 years because of that. And I had done that. I had been very guilty of it. Nobody wants to miss out on an easy gain, but nothing comes easy. And I've witnessed and had a lot of really good mentors. And one thing for me that I found particularly fascinating was, in my personal instance, my father, who had passed away with no money, was very successful. He made $250,000 a year for 30, 40 years, never really had any assets, always acted like a broke person, despite his income levels. My grandfather, on the other hand, retired quite wealthy. He never made more than about $50,000, $60,000 a year. He had retirement homes and airplanes, and he had a really phenomenal life. So in other words, their relationship with money was fundamentally different.
Wow,
one of them looked at money like fuel. They said, well, I have enough. I don't love this. I'm not hoarding it. I'm respecting it. I'm going to treat it in a manner that which it will treat me right. My father, on the other hand, was sort of the poor mindset, where it was never enough. If you get the raise, he'd already spent it. He was always complaining about taxes. He was never proactive. And so it just dawned on me that money is not the problem that we have. Income is not the problem. Debt is not the problem. It's our personal relationship. So when it comes to investing, even more so, it's mindset. So my book is really, it's called Money Mind. It's divided. First half is on just the, in essence, our mind and what moves the markets, what moves us to buy things, and then the actual mechanics of the market, and then really helping investors to differentiate. An example I give to help the layman understand is, when you chase a stock that you see on Reddit, it's akin to going and renting a car. You really don't care what it is. You don't care at all except for giving it back with the wheels still on, and you'll never see it again. You really don't care. Right. When you buy a classic Mustang, that's a family heirloom. You put it in the garage, your kids are going to inherit it. In other words, you don't even want to sell that asset because the money isn't worth owning the asset. So for me, I look at investments like, if you take silver or uranium, just to use those two examples, I buy them with the true intention that I could hold them forever. In other words, if I were to sell my silver today, I'd wake up tomorrow and I would actually want the silver again. So to me, that represents an investment because I want to hold that asset. So I think that's a real breakthrough for people when they kind of think of it in terms of, is this the forever classic car in the garage, or is this the rental from Hertz that I'm going to just give back and never see again? And really, really critical in making decisions, because I think all too often, another thing I would hear is someone would say something like, well, I have $10,000, where should I invest? And I go, well, that's backwards. That's completely backwards. You save that 10, turn it into 20 or 100 first, and start paper trading. Find something that maybe you love, Apple or Tesla or Cameco or Suncor, whatever it may be. Find an asset that you love, get to know its habits, understand when it's expensive, understand when it's cheap. And you could even paper trade it, like literally pick targets and trade up and down. Or you can just go, I'm going to buy it in May, I'm going to sell it in next June, and I'm going to see how I did, right? And do that first, and only then start to deploy real capital. And as a youngster, I started trading at 18 years old. I open a brokerage account, I put $1,000 in that account, I sent it to zero, I put another, just like a senior at a slot machine. I just kept feeding money in, going, why isn't this working? And then finally I stepped back, I read all the books, I got on YouTube. YouTube actually was the greatest tool for me, because you can really search any terminology, any concept, it's all there. So there's really no excuse for investors. So ultimately the book is a practical first step for an investor to say, hey, here's some tools, here's some things to think about. It's a nice quick read, and then only then go out and deploy real money when you're actually doing it as a bank would invest. I would say invest like an institution, not like a gambler.
That's a good
right?
insight there.
Yeah.
Okay, so more of the long-term outlook would be more what your investing style would be. Definitely not day trading. Definitely
no, I'm not day trading. So ironically, I do a bit of trading. I do momentum trading, which is, you could almost call it like weekly trading.
Okay.
But that's completely separate from my investing, and I think that's a big differentiation that most people don't really understand. So I trade only because I love it. I don't think it's for everybody. I certainly know it's a time suck. You definitely need a few hours a day to be a trader, at least, in terms of being on top of your things. But really, yeah, I wouldn't say I'm a forever investor. What I am is I know what my timeline is before I invest.
Oh, okay.
So I may take a shot at copper in January, but I know that I'm going to sell by this December. So it's not forever, but I have a plan in place. So it's like the old analogy: if you set out sail and you don't have a destination, you're just going to swirl in circles until you end up at the wrong place. That's very much what people do with investing. They press buy, they own the stock, and they go, now what? Well, I would often ask them, well, if it goes down, what are you going to do? And they say, I don't know. And they go, if it doubles, what are you going to do? They go, I don't know. And I go, stop investing. Have a roadmap, have a plan. Don't just clunk into something and then clunk back out. In fact, what the best investors in the world is, they don't trade in and out at all. They accumulate over time, and then they distribute back in the market. So my biggest wins I've ever had, believe it or not, I bought that position over the course of years. And then it reached a point in time, a capitulation point, where, okay, now I'm going to distribute back in the market. And that might be 20, 30, 40 sales back into the market, because you hear the saying, people say, I sold too soon. And it's like, well, no, you did it wrong. You sold in one go. So if you start to sell, and then the very next day it doubles and goes up on you, you're gonna feel fine, because you only started to sell incrementally. If you buy a stock on Monday with all your chips, and on Tuesday it goes down by 20%, you're now stuck. You're handcuffed, You're 20% down. If you buy 10% of your position on Monday and Tuesday it's cheaper, you're happy. You're actually now happy because it's cheaper than it was on Monday, right? So there's so many fundamental little rules that have been around for the institutions and the bankers and the billionaires forever, but us retailers never got the playbook. So that's really what Money Mind is here's the guide. This is basically the manual, as it were.
So in a quick way, when you're talking about having a plan, what would you say is how would a person build a basic roadmap to get to where they're at? Say they're starting off with $10,000, they want to build this portfolio up to retire on at some point, or to just have some freedom. Can you take us through an example of what that would look like to develop that plan?
Certainly. I would definitely say know what you're up against. So I'll give you another analogy. So the expert walks into the casino with $100,000 in his pocket. He sits down at the table. His goal is to make 10 grand. Okay, he only needs to hit 10% to walk out of the casino with $10,000. Okay, the amateur comes in the casino with $10,000. He hopes to make 100. He bets the 10. He goes to zero. He walks out. What's the difference? The difference is knowing your weight and your size. So the first thing I would honestly say, if you're investing with $10,000, is be very careful, because it's very hard to make money, any sizable money, with $10,000 unless you have a lot of time. So the single most important factor right off the bat is what is your horizon? If your horizon is long term, you're really flexible. You can let it go up and down. If you put in that 10 and you can't go to 9 or to 8K, you better be careful, because if you come down to $5,000 in 6 months and it's going to cause you to lose sleep, you're in the wrong racket. You maybe should be looking at it a little bit differently. I truly suggest to people it may sound funny, I'd wait till you get a little bit more money, and there's reason for this, and it's ultimately get a little bit bigger of a portfolio so that you can start to deploy smaller bits of capital and be a little more protected and insulated, and you're not shooting for the stars hoping for a moonshot. You're more able to move in a big stack of chips, take a little win, might end up in that case being a couple $1,000s, pull it back, okay, cool, I just made a couple grand on my $30,000 position, instead of trying to make a couple grand on my $10,000 positions, much, much harder, right?
Okay.
So really know what you're up against, know that when you go into a stock in the first place, you're ultimately, you're paying retail. So there's a bid and an ask on a stock. That's a spread. So if you go and you buy Tesla at 110, and the next day the bid is maybe 108 or 105 or whatever that spread is, as soon as you own the stock, you're already down. And then you have your commissions. So you're down before you begin.
There's that slippage in there. Yeah.
So there's leakage, there's loss, there's whatever you want to refer to it right off the bat. So I would say the single most important thing is time. When people say, what should I buy? Why should I buy? How should I buy? Well, what's your timeline like? Because that timeline allows you to be really aggressive or really conservative. And like if any good money, I'm not a financial advisor in any way, any good advisor, you come in and you say, here's my portfolio. If they could only ask you one question is, well, what's your timeline? Because if your timeline is, well, this year we're going to buy a house, they better not put you in the stock market.
Right.
They better keep you in cash and GICs and T-bills and bonds, because when you show up 6 months later and you want the money back for the home and the market had a 10% correction, you just lost a lot of your money. If you say, you know what, I'm 25 years old, this is my long-term money, he can then go and start to take some chances for you, because if those chances go south, guess what, you've got a lot of time to recover. So the single biggest factor definitely is, what's your timeline, how much money, how aggressive are you trying to be in terms of gains, and how realistic are those plans as well. Very, very important.
Okay. Now for people that are a little more advanced, and so we're here at a resource conference, and so we've got all kinds of vendors out here, all kinds of companies out here, a lot of junior resource companies, some that are maybe getting ready for production, starting to make some money. Most of them aren't making any money. So if you just want to take a small portion of your portfolio, and not the whole thing, obviously.
Yeah.
So if you're taking a small portion of your portfolio, how would you approach investing in some of the companies that are here? What are some of the questions? Like maybe if you had 3 questions to ask them, what would you ask?
Certainly. So the single most important thing you got to always think about is what is my price tag? So when they say we're a 25-cent stock, a 2-cent stock, that doesn't mean anything. The market cap is the price tag, right? So that company might have a 2-cent stock with 100 million shares out. It's a $2 million business. So you go, okay, it's a $2 million business. They've got about $1 million of cash. So I'm paying about $1 million premium, right? Very important to understand. And then secondly, who are you? Have you done this before? Do they have a track record of being a promoter with no successes? Or is this their third venture and the last 2 were bought out? So what is their history? And then the third one for me, which is absolutely imperative, and of course the asset is critical, but how vested is management? Are they just collecting a stipend monthly? Are they there for the paycheck? Or do they own 20% of the whole float? Are they on the bid currently? Are they buying shares in the private placements? So in other words, are your interests aligned with management? Because believe it or not, a lot of the times it's not. A lot of the times they're there with throwing their hand up saying, I'll take a swing on this, but if it doesn't go, it doesn't go. And a lot of these guys are down with the ship. So I like to find the down with the ship management, which means if this fails, it's really going to hurt me. And to me, that means that they are going to show up every day. They're going to commit themselves full time. They're going to see through. And if they fail, they fail, and that happens. But at least you know that they're giving it all their bandwidth and their energy because they have real capital invested. But
so
insider ownership.
Quantify that. Now, when you're asking somebody how much skin do they have in the game, how do you go about asking?
I got a 10% rule. Yeah, so a very fair question is, what percent does management own? I would singular that down to what percent does the CEO own, because it gives you a sense if they're a hired gun or if they're a founder, right? Very important. For me, as an investor, I don't like to invest in a small company that the CEO has anything less than 10% to me, because it doesn't represent enough to them whether it goes up or down. They're just kind of there, again, for the paycheck, right? Okay. You got to keep in mind that 50 cents of every dollar raised of these junior miners does not go into the ground. It goes into administrative expenses, it goes into leases, it goes into martinis, it goes into road shows, it goes into booths, it goes into promotion, it goes into travel. I mean, the majority of these properties are helicopter in only. And that is an incredibly expensive thing to rent for a day, a single helicopter. So really understand, are their interests aligned? and what am I paying for this company? Is this a $500,000 market cap or a $50 million market cap? Because it's important to know if the ship's already left and you're chasing. In other words, if it just went from 5 cents to 50 and you're piling in at 50, well, guess what? Everybody from 5 up is already piling out, and it's going to fold back down inevitably, and you're going to be the guy that bought it up at 50.
Right.
So know the chart, know the market cap, know the management skill level and their history, and understand how much they have to win or lose on the transaction.
So to recap some of the questions, you're looking for how much skin in the
market
game.
Cap. Well, I'd say market cap first
Market
and foremost.
cap.
What is the price tag of the business? What are you paying for the company? Right. What's your market cap? What is the history of the team? Are they proven? Are they unproven? And how much do they own? Right? How much skin in the game do they have?
Right.
Yeah. And to be honest, those 3 questions will eliminate probably 90% of these opportunities. Right?
Okay.
So what was said yesterday, which I thought was very good, don't go here and say, well, what are the 2 or 3 that you like? Go and find 100 that are no good. And then when the one that you're like, you know what, this one seems like okay, oddly interesting, those are the ones you pursue. So it's really a business of bullshit detecting, in my humble opinion. And that's really what I wrote the book on. Is a good investor ultimately is a bullshit detector. Ray Dalio prides himself because he says, I look at ideas all day, I say no all day. All day long. I look at 100 ideas, 100 ways for people to take my money, I say no, and then I get that one, like, wow, everything seems oddly good here. The CEO is totally committed, he's done it before, it's a right price tag, I'll take a shot on this one. And you're gonna win if you stick in that arena.
Terrific. Well, I know our time here is short, and I know you've got a lot of people to meet here at
thank you
the conference.
having me.
And so, just for the folks that are watching, what's the title of your book?
The book is called Money Mind Beyond Speculation, and it is on
Mind Beyond
Amazon. It's on Audible, Kindle, so you can get it pretty much all the usual formats.
Okay.
And available. SuttonVentures.ca is my site where you can get some more information on it. I'm on Twitter, Brayden Sutton, and pretty much available to anybody who has any questions. I started out as a retail investor. I am a retail investor. I was not from the industry. I was never a broker, a banker, a son of a banker. So I pride myself on being an infiltrator, a true a normal guy, a from the street, working class guy that was in the trades that literally came into this business. So I say that to say anybody can learn to be an investor. It's not exclusive to people that are in the industry, that are blue blood from, there's a lot of really good books out there. Just if you want something, immerse yourself in it, but anybody can do this business, but really differentiate investing versus just gambling and just following a herd.
Okay, very. Money Mind Beyond Speculation, available on Amazon. Brayden Sutton, thank you very much.
Thank you,
Pleasure
sir.
to chat with you
Thank
today.
you for having me, Clayton. Yeah.
All right.
Enjoy the show.
Thank you very much. All right. Enjoy. All right. Thanks, everybody. Take care and bye for now.